Thanks for making time to make it all the way to IMB today. I've heard there are a lot of traffic and road restrictions, so really appreciate your time. Really? I'll give that feedback to the team. But before we start, I just want a flavor of the audience. How many entrepreneurs here? Not necessarily. How many from the banking or the lending side? How many VCs here? Okay, we can do some batching.
Nice.
Yeah. Anybody from the academic side? Yeah, sorry, someone was saying something?
I said we're all from the borrowing side, not from the lending side.
Okay, great. So let's get started. We're here for discussing alternate financing for early stage startups. An introduction of the panel here. I'm Nachiket Kulkarni. I head the social entrepreneurship incubation here at NSRCEL. Personally interested in alternate financing. As an entrepreneur in the past, I've gone through these troubles of trying to raise funds and having those meetings again and again. And even at NSRCEL in multiple verticals, we are trying to bring in the whole module of educating entrepreneurs on alternate financing. And more than, I would say, educating, it's the awareness first, and then making entrepreneurs understand based on their professional and personal journeys what to choose at what point. I'm joined here by three of my fellow colleagues in the industry. Amar here is an advisor turned entrepreneur. Right now, founder partner at Record Club. Previously was in Marsh & McLennan, around 8 years of experience in cross-border M&A and structured debt industry. We then have Sai, who is currently a principal at Yunus Social Business Fund, Bengaluru. He has around 11 years experience in investment banking and in companies like O3 Capital and KPMG. And then we have Prashant, who is one of our own NSRCEL incubatees, co-founder and CEO of Valley Z. It's a smart parking and EV charging venture based out of Bangalore. In the past, he has been with Avishkar Group and has worked with multiple Fortune 500 firms. So with that, I'll probably pass on the mic to each of them to probably talk 2 minutes about what they're currently doing.
Yeah, sure. Hi, good morning, everyone. I'm the founding partner at Record Club, and Record Club is a financial technology platform. We have facilitated financing for asset-light companies. At Record, I primarily look after the growth side of things. So as you pointed out, looking after the borrowers is my day job. I ensure that they get the right form of capital at the right time, and all of that structured debt advisory is what Record Club currently does. We don't do any lending. We're not an NBFC nor are we a P2P lender, and hence looking after the borrowers is all that we do. So ensuring the right form of capital at the right time is what Record Club stands for, and something that I'll cover as we sort of speak and engage during the session.
Hi, I'm Sai Kumar, principal at Yunus Social Business. So we are an impact fund, and we are on the lending side. So we do, we lend to social businesses. That's a niche that we have carved for ourselves by the philosophy of Professor Mohammed Yunus. So my day-to-day job would be, evaluating deals across sectors that we focus in, but not just investing in them, but also looking at portfolio management, which basically is post-lending support for these companies.
Good morning, everyone. As Nachiket is introduced, I'm Prashant. I'm co-founder and CEO at Valley Easy. We are a smart parking and EV charging network. And I'm the borrower on the panel. So my sympathies with everyone in the audience, as always. So we've been around for about 7 years. We basically build technology that digitizes and organizes parking infrastructure, and lately we've been rolling out EV charging stations as well as the penetration of EVs rises. So that's basically what we do, and happy to share more as we get into the panel discussion.
Thank you all for making your time again. So what I'll do is I'll just probably stand for a bit and set things up, and then since it's a masterclass and not a panel, everyone will probably have 10 or 15 minutes for themselves to talk about what they want to share. So why are we now talking about alternate financing? Like, what has happened microeconomically? I'll just open it, probably one or two of you if you want to answer this. Why do we want to talk about different options? Yeah? Talk.
So I'm in the education industry. So seeing about how prices is falling off, like businesses are taking a step. Thank you. So I'll just come again. So seeing all the tech companies like Vedanto and Byju's is falling up, even though they are taking investment, they are burning cash a lot. Even it is a small company too, even though they are very innovative and using tech-based also, investors are taking a step back and thinking a lot. And apart from that, not every company is ready to VC funded at all the time. As a 1 year startup, I'm looking for grants. I don't want to pay back. I don't want to run for the money. Okay, I just want to have the money. I want to build
When
in
did
a
you
slow
start?
pace. So a year.
Okay, yeah.
Yeah. So that is why one point we need to look into alternative
Awesome.
financing.
Anybody else? Going 1, 2, 3. Okay, yeah.
Hello. Yeah, good morning. And this is Srikanth from Sunwind Eco Technologies Private Limited, Chennai. We are into the clean tech domain, and mainly for the startups, the bank don't finance, to be frank, and they make us to run here and there, and they do nothing. We waste our time.
We
So
have
that is the
SBI's
reason.
lending head sitting here.
My experience with banks is bitter, not good, and
Okay.
maybe something lagging from my side also. I would not have chased them. That is the reason I'm here.
Okay, great. So I'll get into the depth of what's happening macroeconomically, right? COVID happened, all of us know. The Ukraine war happened, and certain bank failures happened in the last 2-3 years. There are certain macroeconomic trends which are specifically affecting the banking industry, and we'll go a little bit more into the detail of 3-4 factors where entrepreneurs like all of you want to sort of look at other options, and it makes sense. In India, specifically, we are looking at around, this is venture capital funding going down from around $1.2 billion to $733 million, a 29% drop year on year. Globally, of course, you see again, it's a larger number, it's a 75% drop. A few reasons. There is dry powder built up with a lot of VC funds, which means that, especially in India-focused funds, they've had capital, they've actually parked capital to deploy, but because of a change in perception, a change in the need for robust business models, which, where growth at any cost model is probably not the way to go in the last year or so. Especially because some of the examples that you mentioned, what has happened in the past. It's not the same scenario as 2014, 2015, or 16. More and more founders are choosing to build VC independent business models. We heard somebody say, I don't want to pay back. I don't know how long you can say that, but that is the mentality that is setting in. More importantly, I think some businesses, as we know, are probably doing well and sustainable businesses, but may not fit into the venture capital asset class, if you will, right? Because that asset class expects a certain set of returns over a certain period of time, which every business or every business model cannot give back. So a few specific, I would say specific reasons why all this is happening, at least from the entrepreneur's point of view, right? How many of you have gone and pitched to, at least 10 VCs in this room? Okay, yeah, there's one on the panel, that's great. Yeah, so it's an exhaustive process. Data shows, as of 2019, early 2020, seed round takes probably 12 to 18 months of conversations and meetings to close. While it is a long time period, mentally it is fairly exhausting for the founding team to go through this. And it's a don't know phase, right? Like you're going and probably meeting 20-odd funders, and from everybody you meet, you have this don't know phase for a month or two. And in that phase, you also don't know what to do. Obviously, you have to chase everybody at the same time, but it's an exhaustive process. It's a toll on the founding team. Complete autonomy again. Once an investor comes in, obviously you have exit pressure, you have board seat, you have lock-in periods, all sorts of terms and conditions that come along with the SHAs and the term sheets. Expectations, which is something we covered earlier, right? Practically what can happen on the ground. versus what you can deliver based on your initial conversations and the financial commitments. The gap between that is widening. And of course, limiting the dilution there again. Like due to multiple funding rounds, the amount of equity that you own in your venture will obviously keep going down. So that's a concern that has come up with multiple entrepreneurs again. And we see this at NSRCEL, and we've had this conversation with multiple incubators as well. That these are the top 3-4 things that we thought are pain points for entrepreneurs, and hence. If you look at, in my opinion, this is a personal opinion, in 2008 subprime crisis, you had, the Facebooks and the Airbnbs as a revolution. Obviously, with a calamity or a crisis, new ideas come up. And I personally believe with the recent macroeconomic trends and with the emergence of multiple alternate fundraising platforms, that's the revolution that's going on right now, in my opinion. And I think the scenario has led to emergence of such innovations. And we'll be covering a few of them so that you guys get to know, at least by the end of the masterclass, what is available out there. Yeah, so with that, I'll set it up for Amar. Over to you.
Nachiket, thank you so much. You've set the base perfectly for the discussion that I had in mind. I don't need to bash equity at all. I think Nachiket's done that for me. So I'm just going to focus on the alternative options that exist in the market. I think it's extremely crucial for every single entrepreneur sitting here to really feel what their first seems like. So before I even dive into what alternative financing options are, how exactly can you utilize them in your capital stack, let me quickly show you what your firsts are. Cherish your firsts, right? It's always, you registered the company, you're happy. You got your first funding, you suddenly have a cash runway, you're super happy. And then there's a first customer that pays you and you're the happiest. And now you know that you're going to pretty much conquer the world till a scenario like this pops up. One fine day, you're just sitting and talking to an onion, and the onion says, cash runway is only 2 months. And I suddenly turn into that. This has traditionally been how financing has been working in the Indian ecosystem, or for that matter, in the global ecosystem as well. I picked up some public data. These are companies, these are startups which were in the 2008 or the post-2008, which really took off, what their current shareholding really looks like, because equity was the only option that they had access to. Very quick sort of all household names. I'm sure everyone here in this forum knows these 4 names that I have on the slide, right from Zomato, Policy Bazaar, Delivery to PharmEasy. As Nachiket pointed out, there are, well, equity has its upside, but equity also has its downside. One of the most common analogies that I discuss with founders, and now there are about 500 plus companies trading their revenue on our platform. The most common analogy that I discuss with founders is, I have created a house. I have built my house. I have a 5 BHK. And now, just to raise capital, I am saying I'm going to rent one of my rooms to a complete stranger who does not understand my house rules. Hence, raise equity, but raise equity strategically is very important. Blind raise of equity over just 6 rounds of funding will take you to a sub 5% holding in your own company that you have created. These are facts. Moving on. The world is changing, and as the world is changing, there are various asset classes that are there on the horizon for us all to explore. I am going to deep dive a little bit on this particular slide and obviously take questions up later. We already discussed traditional equity funding. Now, while Nachiket was talking about the downside of equity, I personally am also a very firm advocate of having equity at the right time during your company life cycle. One aspect that a lot of founders actually miss, I do note one of the members in this particular forum actually mentioned grant. One thing that actually differentiates between a grant and equity is this last aspect, which is the cost. Just because equity is coming into you and you don't have to return it back doesn't mean it doesn't have a cost assigned to it. Cost of capital, and there is pure mathematics here, there is no discussion, there's no public forum that you have to go to, you have to just quickly see the math on the previous slide, and you will note that if you dilute too soon and then raise your top line, you're always going to get valued at your top line, and every single investor coming on your equity cap table is going to make you dilute more and more. So hence, please pay attention to this particular cost aspect of equity. I have been very, very lenient in terms of my timelines. I have only kept 3 to 6 months here. I can give you my personal experience. It took us about 9 months to sign our term sheet, and then it took us another 6 months after that to get cash in bank. So a traditional equity journey does take time, and hence it's very important to plan your equity with alternate asset classes that exist. With the advent of venture equity came venture debt. Now, while venture debt, another great instrument, has certain restrictions that I will talk about, and obviously deep dive on the benefits of venture debt as well. Great tool to extend your runway. You have just raised equity. Obviously, you don't want to you want to use that money to on OPEX, or for that matter, just simply buying administrative goods in your office. You have to safeguard your equity. Please remember, you've given away one room in your house to somebody else. You're not then going to buy a vase in the drawing room. You want to do something with that money. Hence, venture debt, very limited in terms of its penetration in the market, because venture debt follows venture equity. It will only and only go behind venture funded companies. Hence, they are not data driven. Great play, because with certain share warrants and a cheaper cost of capital, they make access of capital easy, and hence you can, if your use case is extension of runway, good product to evaluate. Moving on to where we stand, in the recent past, everyone here would have seen that revenue-based financing or bets on revenue have become a new play. Now, typically, when your first customer, if you'd recall, in the slide that we were discussing, revenue from a customer can only behave in 3 particular ways. There's no other way that revenue can behave. Either your customer can keep paying you the same amount that he paid you on the first go, either he pays you more for more services, or revenue simply churns and the customer is non-existent. Now, because revenue is so predictable, why not use revenue as an asset class in itself? And that's where alternative asset platforms like we step in. Revenue-based financing, the aspects that I was mentioning, takes a bet on future growth of a particular cash flow. If your customer was paying you X month on month, revenue-based financing gives you upfront non-dilutive capital so that you can simply grow that cash flow by maybe doubling down on your digital marketing expenses, for example, or for that matter, going ahead and spending crazily on your CACs, like increase your CAC, get customers, go for land grab, right? You don't need to dilute equity to get a customer, because that customer is going to contribute to your top line, hence getting you a better valuation. That's primarily revenue-based financing. There is one aspect of revenue-based financing that I do want to point out for the benefit of this particular forum. They penalize you to grow too fast. Now that, as entrepreneurs, is very important for us to know. What is cost of capital and what is true cost of capital? Please understand, true cost of capital is when you look at something in XIRR terminologies, internal rate of return, not simple interest. It's very important that I understand, if I have taken money, how fast do I have to return that money back? Every single rupee that I return back quicker actually increases my cost factor, and hence revenue-based financing actually sort of curtailed its own chart. Recker and Recker Club financing primarily values the predictability of your revenue, and hence we simply look at how this revenue will behave basis its historical trend in the future. The ability to simply raise capital on a discount, and this is something that a lot of entrepreneurs here will relate to. Please think of it this way. One of the metrics that all of you would be looking at in your companies is the lifetime value of your customer divided by customer acquisition cost. How will I know that I have been able to get the right amount of money from this customer by amount that I have spent while acquiring him? This is where you have to look at cost in a slightly different way. To increase the lifetime value of a customer, all entrepreneurs generally want to discount their service. If they were paying me 100 rupees month on month, just to increase my LTV, I will say, pay me 800 rupees annually. Why? I am self-discounting, hence eroding my top line, which is eventually going to lead to a lower valuation when I go ahead and raise equity. And hence, what we offer at Recker is a discount other than self-discounting. If I can give you a platform which can simply allow you to raise your future receivable, non-dilutive, non-restrictive, by evaluating simply your cash flows, it's a cherry on the cake. And that's where Recker Club financing stays. I'm not going to deep dive too much into it. Happy to take queries towards the end. But all these asset classes, because the new age is here, there is a new competitive landscape that we are all operating in. There's a quick comparison that I want to draw to slide 4. The red line was equity ownership of those companies that purely were raising equity capital. If they had complemented their equity raise with the right form of debt capital, the right form of alternative capital, These are the numbers where there could have been a 10% potential shareholding save in 6 rounds of dilution, hence amounting to about, well, close to $100 million. Who doesn't love money here? As you mentioned, you do just want money, you don't want to give it back. So this is a quick comparison. Traditional way of just raising equity versus raising equity with the right form of debt capital at the right time. While I have spoken about this, when we started Record Club, these are founders. When we told them that I can help you save your own equity by giving you access to capital, every single founder jumped like Akshay Kumar saying, मुझे interest है, मुझे interest बहुत है, but कितना interest देना है? Hence, it always comes down to cost. Cool. I did touch base on this in the previous period as well. Like I said, very big advocate of equity capital, but the right form of equity and debt needs to be there to create an efficient capital structure. Just to deep dive here a little bit, installation period, or for the larger group here, pre-product market fit requires an entrepreneur to speculate. It requires you to really understand your customer, and hence you need to spend your time in understanding your customer, his requirement, and how your product can meet those requirements, not raising capital. So in this particular time period, when you are pre-product market fit, you do need VC capital because they will always give you a multiple of your top line, and hence you have the ability to experiment, you have the ability to find PMF. But once you're in your deployment period, which is product market fit or a particular threshold of your annual recurring revenue has been achieved, that is where you need to start getting alternate asset classes and debt into your capital structure. Very important that just do not over leverage yourself with debt. Even debt has to come in its right form. It is not just taking long-term loans or short-term loans or rotating loans. It is the right use case identified by the team which is running the company, and hence the right form of capital needs to come in. Cool. Truly, it is very simple. All you have to do is understand the chronology. अगर हम chronology समझ गए, raising capital is the most easiest form that exists today in the market. Equity will always follow profitability. And if I am building a model where my customer's need is getting met and I'm being able to acquire more customers, automatically equity will chase me. Okay, I have kept a couple of case studies. We have now been in existence, and as I mentioned, we are working with about 500 odd companies. There are certain specific use cases that I've seen founders utilize our platform for, and in general, a lot of alternative assets. The first and foremost are working capital gaps. Every single entrepreneur here, including myself, I have faced a working capital gap, which is that receivables will always come later, especially if you're in the enterprise segment and you're working with enterprise accounts. Unfortunately, let's call a spade, you do not have the negotiating ball in your court. And hence, they are the ones who are going to decide your credit cycle. Working capital gap is one of the biggest aspects that I'm seeing founders come and raise debt. You do not want to plug your working capital gap with equity money. It's not the right amount that you have spent to use it there. A lot of companies that also operate on our platform use us for bridge financing. A company that has raised equity, yes, that's validation, that's great, that you have equity, you want to invest in R&D. But you again don't want to dilute too fast, too soon. Hence, they delay their round. They want to acquire more customers. They want to double down on the services that they are offering via debt so that the next round can be delayed and they can decrease their dilution over a period of time. One other aspect that we have seen most of the companies do is they have an equity term sheet. And for example, just for the ease of mathematics, if they were diluting 10% to raise $1 million, they are still going ahead and signing that term sheet, but now complementing debt of 200K on top of that, and hence raising $1 million in totality. So if I was raising 800K for 8% and saving 2%, eventually over 6 rounds, I end up saving 10% shareholding in my own company. Just to reiterate, because that is the most important aspect that has to come out here today, is right form of alternate capital at the right time to deal with the identified use case is the correct way for you to build an efficient capital stack. Yeah, that's IIM Bangalore. I know the image is not very clear, but that's where I'm going to leave all of you right here, right? That's a famous scene that all of us here have gone through. Hence, value your equity. It's extremely important. You start with only 100% of it. After that, it's a decreasing trend. There's no way that you're going to go above 100%. With that, I'll leave you all with Sai.
Okay. Before we start, how many people in the how many founders here think that they've started social enterprises? Okay, so we have an audience. So given my background, I'll stick to alternative financing for social enterprises because financing itself is something new for social enterprises. We typically, as soon as we relate social enterprises, it goes to OK Grant, or somebody is going to like donate some money, so we'll take that and push. But then this concept of let's say a grant is something that can stick with, let's say, a non-government organization or an NGO. But what about a social business which is running as a business which wants to be sustainable financially? So then, what options do these people have? So I think the same debt line, because equity is something that is there for everybody. You have impact investors, but very few people have know of debt for social enterprises. So one of the ways that you can explore debt for social enterprises is this kind of outcome-based payments. Now there are different models that have come up, or innovative structures that have come up for outcome-based. It simply is to say that there is a particular work done, and for that work there is somebody who is ready to pay for that service or for that work to be done. It can be a very simple example, like let's say a particular foundation does not have expertise in, let's say, on-ground tribal area education, but that is one of their motives, or that is one of their aims of the foundation. So this enterprise can be a service provider, and once the outcome is met, that is, let's say there are certain metrics that you decide with the donor or the government, you could make a payment at the completion of the project. That's one. Of course, the models which are there are basically social impact bonds, social impact incentives. These are known. Some of them are known models. Some of them are just out there as a concept, but yet to be experimented on. The second one is quite close to the first one, which is a milestone-based disbursement. So you don't get all of the money, even if it's debt, even if it's equity, you don't get all of the money in one tranche or in one go. So there is a milestone, and as per the milestone, you get your money. This is also something that we at Unisocial Business do for most of our loans. So when we give a term loan, even if it's for let's say about 3 crores, it's not that 3 crores is disbursed on day one. So there are number of parameters that need to be in check that ensure that impact on the ground is achieved, and hence when that milestone is met, we disburse the right amount of capital. The last one that I've put out here is interest subvention, and this is slightly technical, and if I'm not clear, maybe you can check right away, or we can take questions even later. This is to say that there is a person who is lending money, but that money is being lent by, let's say, somebody who wants to create impact. So if there are metrics, or if there are measurements that can be done, and the cost of capital itself can be reduced. So Amar spoke about a lot of cost of capital aspect of it. So I'll maybe give a case study here of an actual case that happened in India with a social business and with an impact investor. So you all would recognize the thing on the left, which is MSDF. So they had they were basically subscribing to an NCD from a social enterprise, which is Vartana. Now Vartana is an NBFC that lends only to the education sector, based in Bangalore. So they have been in existence for a while. So they basically provide infrastructure loans or working capital loans to affordable private schools and government schools.
You might have to explain NCD.
Okay, a non-convertible debenture. So typically, because of the regulations in India, it's easier to kind of borrow money when you have an NCD structure. You could also take a term loan, but typically term loans come from banks per se. NCDs, other entities can also subscribe to NCDs. So It doesn't necessarily have to be a financial institution. So hence NCD, yes. Yeah, that's so NCD is an instrument. So it's basically like a debt. It's a debenture. Basically, let's say there is your company that wants to take loan. You can approach, let's say, SBI and take a loan in the form of a term loan, working capital loan. But let's say there is somebody else who wants to lend money to you, right? If the other person is not a financial institution, it's easier just to have like a loan document, which basically is a debenture document, saying that, sorry, not necessarily. And using that document, you can allow the non-financial institution to maybe lend to your company, right? So the way this kind of worked was that they had a 3-year NCD with a fixed return rate of 3% and a variable return rate of anywhere between 0 to 9.5%, right? So what was happening? So at the start of the project, MSDF and Vartana had clear metrics drawn out, saying, let's say, okay, you have to expand or you have to give out loans to X number of schools. So today you are at, let's say, 100. Tomorrow you need to be at 200. So if you achieve 200, then your interest rate maybe comes down from 9.5 to, let's say, about 9.25. I'm only giving an example. These are not actual metrics that were there, but I'm saying key metrics, once decided between the two parties, can kind of come down. And this was actually linked to learning outcomes of the students of those schools. So in that way, MSDF ensured that through their debt mechanism, they actually had impact created on the ground. Enrollments in schools, expansion of number of schools that this Vartana could expand to. 3, maybe also in terms of what are the learning outcomes of those students in those schools. So all of these metrics were considered, and accordingly the variable pay was decided at the end of the year. So there would be an independent authority which would do the impact assessment, and once that is once that the result of that was clear, Vartana had to pay back MSDF the rate as per the pre-decided chart. When is this possible? Of course, if the grant provider is somebody who or the debt provider is somebody who really has that the intent to create impact on the ground, that's something that at such time this can work. Of course, there is a need for some kind of steady and predictable cash flow, because ultimately the underlying asset or the underlying instrument is a debt instrument, right? So there has to be a cash flow mechanism that kind of is in sync with this with the instrument. Of course, the two really important things are clearly defined, measurable, and objective impact metrics. So these can be things that might crop up as an issue at a later stage. So have that clear during the time of discussion itself. And the last thing, of course, to keep in mind, to many social impact or social related projects kind of fail in terms of financing because the ancillary costs are greater than the reward. You go about your legal structures, your legal costs, trying to get the money from, let's say, from abroad into India. All of these have costs, and hence only if all of those costs are greater than or lesser than the rewards that you will be able to achieve at the end of this, only then go in for this kind of a structure. So I'll leave that with we can maybe take it to the end. Yeah, thank you. Okay, moving on. Sorry. Okay, how many of you recognize what this is?
Social stock exchange.
Wonderful. So great. We still have an audience. So this is basically the new logo that the social stock exchange has been the talk of the town for a couple of years now. So I'll not delve deep into regulatory aspects or those kind of aspects, but how can this be used as an alternative financing mechanism for social enterprises. I'll be only focusing on that part.
Just one question before you move ahead. Is Section 8 registration compulsory in order to be a social enterprise?
I'll just come to that. Sorry. Okay, so is this concept an Indian concept? Is it something innovative in India? When Nirmala Sitharaman introduced this in her budget speech in FY20, was she like the first person to think about it? Probably not, because this has been in existence from about 2003 when it first started in Brazil, right? I've kept that comparison still there. These are not the only 4 social stock exchanges in the world. There are, of course, about 7 or 8 of them, but just for the the space here. So about 3 of them are only active today, and of course the Singapore one is kind of low active. So as you would see that it's been in existence for pretty much a long time. So 2003 till today is pretty much 20 years. So they have been evolving in terms of ideas. Many different kinds of concepts have been tried out. One is to have independent social stock exchanges. Some of the newer ones are incorporated under existing stock exchanges, which is the idea even in India, which is to incorporate it under the BSE or the NSE. The point that I really wanted to kind of bring about is that many of them have had this. Many of them have had different evaluation metrics or different criteria to allow companies to list onto their platform. Many of them have also had criteria for investors to list on the platform, like SVX Canada is one of the countries that, or one of the stock exchanges that really screens investors as well. Only if they pass certain criteria, only then they allow them to come onto the platform and subscribe to the instruments that are there. But a key factor that is there is that secondary trading per se. So while the name is a stock exchange, secondary trading of it is still not really established in any major SSE. So to expect that to happen in India will take a long time, because global comparative markets have themselves not evolved to such a stage, right? So I'll maybe close with that, and then move to what exactly is the value proposition that SSE would bring to both investors in social enterprises as well as companies that are there. So one is, of course, a national validity, or at least a national platform for people to acknowledge that there exists a social enterprise with doing this kind of work. The next is strategic connects to people across India, which many times NGOs or even social enterprises do not have access to. The third, of course, is additional pools of funding, which is new fundraisers or new grant raising mechanism. And because it's a common platform, or it's a stock exchange kind of a platform, it is going to lead to lower cost of funding, while individually these trying to get this kind of funding would be quite costly. From an investor perspective, I think it is access to some kind of credible organizations, because there is certain benchmarking or there is some kind of reporting that needs to be done by all of these companies before they list, and hence investors have some kind of data, some kind of standardized data that they can have access to. Impact, visibility, and transparency linked to the previous point. Lower compliance risk, because there is some kind of history in terms of measuring impact, and in terms of them being on a platform and regulated by following SEBI and the stock exchange. And of course the last one being diversification strategy. So instead of investing only in private or investing only in private markets, this is slightly a public platform, and hence it could kind of lead to lesser losses. The last thing that I will kind of cover is how all of this will kind of happen. So there is once the primacy of social intent, and for this there is a clear definition or criteria laid out by the stock exchange or by BSE, which says that if you're operating in 15 sectors or trying to achieve any of the 15 goals, then there is the primacy of social intent. Once that is decided, whether an organization is an non-profit or a for-profit organization, so that's the classification there. The NPO registration guidelines. This is as per regulatory requirements. Once that is done, there is this this is the innovative product that this SSE has come up with, which is a zero coupon, zero principal repayment. So which basically says that a company can, so if an organization were to issue debentures, they don't, at the end of the maturity of the debenture, they need to return principal as well as the interest accrued. But in this kind of a structure, there is zero coupon, that is zero interest needs to be paid back and zero principal needs to be paid back. So this is basically legitimizing a grant through an instrument which is a ZP structure. They could also, there could also be social venture funds, which is the AIF2 category, which can, of course, list on, AIF1 category, which can list on the stock exchange. The other one is, I'm guessing a lot of crowd here, which is for-profit enterprises, which are in the social impact space. For them, you could list and use that as mechanism, or use the social stock exchange as a mechanism to raise equity or debt, or even have the AIF structures or social venture funds invest into the company. So I'll maybe close with that, and this is basically the alternative financing structure that probably is a national platform which many social enterprises can use going forward. Of course, like all of you, waiting for the implementation actually on the ground. This has been in the talks for a long time, so looking forward to whenever this gets actually implemented. With that, over to Prashant for Balazi.
So good morning everyone again, and so what I'm going to do is I'm going to give a quick background about what we do at our company, because that will sort of explain the journey that we've had from a financing perspective and the choices we've made. So Valet Easy started in 2016. We started our operations out of Bangalore as a company that builds technology to digitize and organize parking infrastructure. That's really what we started. So when we talk about technology, we are a company that builds IoT products and a cloud-based software platform. So obviously as a business, when we are in the parking business especially to begin with, a lot of our customers are the owners of properties. So it's a bit more of a B2B kind of play. And obviously when you are solving any problem in parking, you are solving a physical problem. So you will have hardware as well as software. There's no business in parking that you can run as a pure software only. Which means that we had to figure out a way to sort of build our business and figure out a journey to scale as well. ChargeEasy, which you see on the right side, is a more recent business, which is EV charging stations. And again, in the charging business, we are again a full stack platform. So we actually build charging stations as well as the software and the user interface, which allows users to find and access charging. So as you can understand, again, there is a hardware and a software story, and that influences the kind of financing choices we make. Now, since the time we started, we've been around for 7 years. So on the parking business, we've grown a fair bit. And we have a lot of recurring revenue customers, especially on the B2B when we work with a lot of properties with both parking operators and parking owners. We started out of Bangalore, but we're present in at least about 18 or 19 cities at this point in several states, probably a bit larger in West and South, more recent in the North. Also, as you can see, there's a lot of volume in terms of transactions that we've handled. And we have a relatively large team, which means a lot of mouths to feed at the start of every month, as you can see, which is a problem of its own for entrepreneurs, right? So when you have this context, what we are trying to, this will give us some sense of how we are thinking about capital along our entire journey. And so what I have tried to use is a simple timeline to give you a sense of what we did at different points in time when we started. So like all companies, which starting out, we are obviously a completely for-profit operation. So like all companies, when we started out, we look for money on equity, which is obviously friends and family like everyone does, and then we moved on to angel networks or angel investors, and that's pretty much been the journey for the first 3 to 4 years. I think one thing from our context is that we've always been a revenue-focused organization. So we've always, month 2 of our existence, we were making revenue. So we never had a philosophy where we wouldn't be making revenue, and that influenced the choices that came later in our journey. So obviously everybody has their own view of how they want to build their business, but that's the story that we built. So which also means that we were not one of those companies that were losing, which were having expenses which were 4x of revenues at any point. In fact, it was probably the other way around. It was usually more that you might have losses which were 25% of revenues for a relatively large part of our organization. And in fact, now some parts of our company are actually at fully break even and they make money. Again, that influences the choices that you make in capital. So what that means is that we were able to, both out of circumstance and choice, we were able to relatively raise smaller amounts of equity capital and keep building the business. And that's kind of how this journey started. What you see in 2019 is an example when we actually got access to a grant. So we've actually tried most of the kinds of instruments that have been covered by both of the earlier speakers. I think what we are talking about is when did we make those choices and why did we make those choices. So the grant that we got in 2019 was actually because we were building a version of our system for a new kind of use case, and we were part of an accelerator program. So one of the things we've realized is R&D makes sense in 2 contexts. One, it's very important to establish whether you are building something innovative because people want to fund innovation through grant. People don't want, I mean, at least in a lot of tech businesses, they're not interested in funding any regular operations. So you have to be very clear on whether you have a positioning that allows you to do that. The second thing in our context is that a lot of times, if we would look at grant, we were also looking at for innovations around hardware, which is a deeper challenge than building around software. To be honest, building around software is usually more a salary problem. But building around hardware is a deeper problem because you need to have capital to build prototypes and all of that kind of stuff. So again, that's what we did in 2019. That was the first time we used something other than equity. And when we used equity, we mostly started our journey with CCPS and then CCDs, which is the traditional way that most people do things. I think Nachiket introduced this session by saying that we are in funding winter. Funding winter in our sector started in 2020 with COVID. We're a mobility business, so I don't think if you're moving around, you're going to be needing much parking. So obviously for us, the story pretty much started in the middle of 2020, and I think one of the reasons we are here is because of the way we structured ourselves in the beginning, which means that if you are focused on building a business and not just on a story where you're chasing growth at all cost, you have a slightly better chance of pivoting to situations like 2020. Now, I'm not saying a situation like 2020 is going to happen every 5 years. Obviously, there was a once in a 100-year event. But situations like that could happen in your sector. It's not a macro. That is global macro, but you can have stuff like that happening in your sector or in the geography that you're operating, stuff like that. So one is you want to think about, as an entrepreneur, about how you structure your business, not because you can foresee the risks, but you have the flexibility to adapt to the risks. So obviously in our context, that was a big issue. Incidentally, that it was during COVID that we were also connected with NSRCEL for a program, and it is through that program that we got access to something very interesting, because we've looked at working capital financing for some time, at least since 2019, which is when we were pretty confident of having recurring revenues with a certain amount of clients on a regular basis. And that made sense for us, but obviously those days we were not very sure on what structure we wanted. What happened with NSRCEL for us was actually that there was an interesting tie-up that NSRCEL and IIM Bangalore had with Indian Bank, which was actually a startup loan program. Now that's something that I have been looking for a long time, in a sense, because see, before I started Valley, I used to work with Intellicap Avishkar, so they did a lot of work around financial inclusion and digital finance solutions. So I was familiar with the whole CGT, MSC, and all of those kind of structures. And it was intriguing for me that banks were not looking at that in a systematic way. At least when we started in 2016, there weren't that many fintech firms also facilitating lending of different sorts. I mean, there's a lot more today than you had even in 2019. So that tie-up was very interesting because it meant that you had someone was actually willing to utilize a mechanism that actually existed but nobody was willing to risk, which is how do you fund an unsecured loan or at least a partially secured loan for a startup that wasn't yet having a 3-year profitability record, which is the number one reason that any person in this room probably doesn't get anything from a bank most of the time. So that was a special case, and we benefited from that because we applied for that. And it was, as in all processes, it obviously takes a little bit of time. It took a few months, but it was worth it because for us it was about two things. One was to understand whether we could work with a bank, because for us it's about building a track record. If I can work with the bank, I'm sure we can over a period of time work with other institutions who are further in that value chain of finance, including other forms of unsecured credit and all, because your track record is what you build over time. That's how debt works. Debt works with track record. And track record builds its own credit worthiness if you are able to repay. So that is something that happened for us, and that's been quite useful because it got us through as we were starting to rebuild our revenues. It triggered at the right time in 2021, and we've been able to use that. So we've actually renewed that, and that's going on. Now, as business started to scale more in 2022, we were building some innovations in our own business, and those innovations led us to look at transaction-based financing. So in our kind of business, so Valet itself is an innovator in the parking space in terms of bringing FASTag to parking. So I'm sure everyone who has a car has a FASTag. Now FASTag was used in tolls. We set up actually the first mall in India for FASTag, for parking, and first hospital, and a lot of firsts after that. I mean, we pretty much set up the second, third, and the fifth and the 10th properties that use FASTag. Now, why were we doing that? See, parking in our business, cash is a big part of how you handle transactions. Now, that is a big barrier for us to get finance and for the guys we are working with to get finance. So we had to find a way to change that. And FASTag was one of the ways we were doing that. Obviously, UPI and others are also there. But what effectively you were doing is what a lot of the e-commerce or rather the Khata books of the world and all trying to do in retail, which is create a track record of transactions so you can do cash flow or revenue-based financing, which is exactly what is being discussed. So that's what was happening in our business. And because we were doing FASTag, by nature, we had a bank tie-up. In this case, it was with ICICI Bank, which is also the pioneer in FASTag. And so we were able to create a mechanism where we were able to bring credible partners or property owners with whom we had an established record. And there was an established record of transactions, and then the bank was actually interested to finance those. And the bank was financing ours, and the bank was financing their own properties where we were the partner. And we came in as the technology provider and all of that. And effectively, that is something that allows you to scale in a bigger way, because now the friction is reduced. Because in our business, if I'm dealing with, so we've deployed our systems actually run the entire parking toll at Tirupati, right? So we're talking 10, 12,000 vehicles a day. That's a big. So we're talking. So some of these investments can be as little as 2-3 lakhs. Some of these can be 50 lakhs to a crore. So obviously capital helps. Not everybody needs capital, but there are guys who would prefer to not invest in something that they are not sure how it would work. And this became a mechanism of a go-to market for us, as well as a mechanism to help those who wanted capital. And this was a bit more useful, I would say, for parking operators than property owners, because property owners usually had assets by definition. So they had access to finance a bit more than, say, parking operators who are running a business, and so they are effectively a services business. So the role that transaction-based financing played is a little different than what working capital from a bank for us played. And obviously, moving on from as the business has been scaling, one of the things we've looked at is, in our nature of business, you will have a steady transaction from existing customers and all that. And then every once in a way, you'll get these crazy, large projects or big opportunities which you need to figure out. And that's where invoice factoring came into play for us. So there's a volatility in the revenue that can be, significant. Like, for example, let's say you're doing 50 lakhs of revenue and suddenly you get a project which is worth 1 crore. And you need to do something about that, right? Now, your facilities that are there right now are not designed for that bump up, but you can't even build an alternative that easily. This is one of the better ways to do that. Because especially if you have clients, a good quality client. So we have a lot of good quality folks that we work with today, many of whom are, BSE 500 companies or others like that. So when you work with folks like that, then it's easy to discount the invoice because people know that the buyer, or rather the buyer of the person who's actually going to pay for the invoice is creditworthy and he's going to make good on that. So invoice factoring came into the play more recently. So obviously now when you're doing all of these, the important thing to remember also when you take debt from as an entrepreneur is that you don't want to mix up your collateral with your debts, because even though it's unsecured, there is an implicit understanding that a certain portion of your revenue is committed to covering for the liabilities that the bank has built with you. So you need to be smart about ring fencing that over a period of time and managing it. So for us, it is a phase-wise program. So I would say the things that are closer to 2023 are less mature. The things that are older are more mature. And as we sort of manage the balance sheet. So are we looking for equity? We are looking for equity at all times. As you can see, that's something that I've shown across. But what we are able to do is probably because we are able to keep growing. And also parts of our business today are break-even. And we have managed to grow it even with break-even. We are able to move, as I think the discussion earlier was, that you can move the equity needle and make it work harder for you, or you can sort of afford to wait longer to be able to get through the kind of environment you're in. Now, it's obviously you want to grow fast as an entrepreneur, so we always say that equity is what you want for your growth. Let's not confuse what the role debt plays and what the role equity plays. So that's, in a sense, the kind of journey we had. And that's kind of what I've tried to summarize very quickly here. What are the different instruments and what is the role that each of the instruments played in how we think about choices. So obviously, as I said, equity remains key to growth. It is the best way to scale up. So you should focus on using your equity not for working capital, but for investing in the future, investing in your team, investing in your technology, and all of the usual things, which also is what a lot of VCs would like to hear, or any institutional investor would like to hear. They don't want to hear about you spending 25% or 50% of your capital that you raised for working capital. I think that conversation may not go that well. Obviously, working capital is the fuel of any ongoing business. I think the important thing to understand here is that you have different kinds of institutions which can give this. There's banks, there's NBFCs. You have to look at your own business, understand where it is, how you're able to build it, not just how you're building it today, but how you will be able to structure it 2-3 years hence. Because debt guys will require a bit more predictability. They are not structured for unpredictability as equity guys are. Equity guys are obviously taking a different level of risk. So that means the nature of your business should fit with what you're trying to do. And obviously interest costs. So you want to get something that's at 13% interest versus something at 18% or 23%. And then that is a choice that, it has to work with the unit economics of your business also. It can't be just a random, I'm only getting this, so let me take it, is not going to work beyond for probably 3 months. You'll soon find the problems that come with that. As I said, transaction-based financing can be used in revenue-based financing, works in obviously many ways. It is itself a form of working capital as was discussed. But what we found in our business, and this is something you should evaluate, how it works in different businesses, is it an enabler for growth? Does it allow you to actually go to a new customer and say, you know what, you don't have to buy this from me, I'll get it financed for you. So why don't you close the deal? So if you're the kind of business that benefits from that, then it could be something other than just a cash flow management tool. Because cash flow management is anyway going to be there. You would anyway need that. Like I said, invoice factoring in our context was partly about figuring out volatility. But I would say that it is just going to be part of the overall how your debt portfolio. It is not a substitute for anything else. It is more a function of, and that's, as I said, as your business becomes more mature and your balance sheet evolves, you will be able to figure out what role it plays, but you have to keep that in mind. And lastly, obviously, grants I've already said. You have to look at what role grants. See, social businesses will have a slightly more overarching approach to grant because grant is permissible in many more ways in a social business because you are linking it to the impact that the business itself creates. But if you are a regular for-profit or a tech-oriented business, then grant has to play a specific role in your structure. And that's also the only way you will get it. You're not going to get it for saying that I need to grow my company for 3 months and pay salaries, so give me grant. Nobody obviously gives that if you're a for-profit or a tech firm. But yes, so certain kinds of entities will get it better. People who are doing deep tech, people who are doing hardware, people who are doing biotech, stuff like that. Anything you're doing, then it makes sense. So I think in all of this, the bottom line that I've tried to talk about is that if you're going to use debt, you need to have a plan to be sustainable. There has to be a plan that gets you to break even, because you can't do that you can't play around with debt the way you play around equity. Please understand that you will all have some guarantees and stuff to be given. Now, all of those guarantees will come with various conditionalities and risk mitigations. But that doesn't mean, but that's not the sort of thing that goes away from your life in the way that equity can potentially at least go away from your life. So if you're going to use these options, you should be very cognizant of the kind of business and the pathway towards break even for at least the part of the business where you want to use debt. That has to be very clear from a roadmap perspective. Even if it's not there today, it should be something in your 6-month, 12-month, 18-month roadmap, because at some point it is going to come back for you. All along, when you take debt, you should be keeping an eye on your equity. Your equity has to be adequate to justify the debt. It can't be that debt is not replacement for equity. Let's also not confuse. I mean, that's kind of obvious, but when we start getting into the nitty-gritties of our business, we sometimes miss that picture that I know I can grow the business with the debt, so equity nahi chahiye. But it doesn't work like that. Unless you are a huge high profit margin business that sort of able to build your own reserves, which most of the cases are not. Equity is going to be required. You will have to plan for that as you try to increase the debt. I mean, you can start with, say, something like 25-50 lakhs, but if you want to take it to 5 crores, then there has to be an equity which allows you to sustain that. The bank or any kind of institution, lending institution, is going to ask that question. They're going to investigate that in due diligence. So I think I'll stop here. It's just a quick sort of plan on how we thought about this, and maybe some of this is helpful. Happy to take questions. Yeah.
One second. So I'll just moderate the questions. We have 15 minutes max. You were going. Yeah.
I have started a natural diet property with the aim to create sustainable housing. I've started
It's on.
I've started a natural diet clothing brand called Repeat, which was intended to be 100% environment sustainable. Now, we all need money, we all have to earn. When I went out, it started 1 year back, and when I went out to the market, I realized that it's too niche. There are very few people who understand natural diet, and they don't want to wash. So for me to stand up and to be sustainable and to be core, I have to do something which is not sustainable to sustain this. So if I start taking a certain percentage of something in my business where I do digitally dyed clothing where they are using their water judiciously, but it is not 100% there. So do I get rejected from people like you if I do that? Because I'm standing at this. Okay. I'm standing at this place where I might have to go ESO-free so that the customer can put it in the washing machine. It's just because that is the requirement. That is the pain point there. People, oh wow, Reena, lovely designs and they're so beautiful, but I can't look after it like this. Or I can't pay that extra. I can get 3 garments for that price. So how do I break that but my heart says that I want to be sustainable. I want to do natural dyed only. But how do I stand up? Because one side you have the Belandur frothing lake, and on the other side, I had a big argument with our Naga Prakasham sir also. He said, you have to be organic, you have to be this. I want to be, but I am bootstrapped. And I do not want to have so much of debt or whatever you're saying, because I'm a capable designer and I can make stuff which sells. But my biggest thing is I have to mix it. So if I have a website where I say that, okay, I'm not lying, this is commercial dyes and these are natural dyes, would you all reject me?
I mean, I would reject for other reasons, but
then how do I sustain alternate financing?
That said, so a lot of companies have a target that they want to, or the vision that they want to achieve, which they are in the process of achieving. Like personally at YSP, we have basically we have something that says that a company cannot give out dividends, right? Now that's a very utopian world that we are living in. A company should reinvest all of its earnings to kind of fund the company's growth and not give out any dividends till it achieves a certain scale. That is not going to happen. So people are going to find ways to kind of maybe take bonuses or take salaries or do some other kind of restructuring so that they get their dividend out, right? So my only thing is, if you notice that your product is kind of way ahead of the market, then probably there is some kind of mixing or some kind of non-green products also that can be on your platform, which
So
can be
is
attractive.
there a consultant that I can work with?
I am not in a position to answer this. We don't work with people like
So
this.
that they can tell us that, this is allowed and this is not allowed, because we don't want to be rejected later when we are ready for.
Maybe, ma'am, we can take this offline. We'll just move to other questions. Yeah, yeah. I'll come back to you.
Hi, I have a question. I hear and read about Startup India's initiatives that they give loan facility, mortgage free to certain sectors. I'm into gardening business, so we come under agri-tech sector. So wanted to understand, what kind of options are available from Startup India. Are they, easily accessible, and how can you go about it? I mean, can you go yourself or go through some intermediary to access those kind of facilities?
So I'll take that. So Startup India Seed Fund is what you're referring to, is it? Yeah. So certain incubators are, registered. I mean, basically, we have, for instance, NSRCEL has a permission to actually use the Startup India Seed Fund to deploy to certain startups. There are certain criteria again for that. You have to be private limited. You have to be running for a year, have certain revenues, certain sectors. So again, it's the responsibility of multiple incubators. Like NSRCEL has to do this every month or every quarter. I don't exactly remember the criteria, but happy to take it offline with NSRCEL team to actually give you the correct answer. Okay. But I'm not sure if you can directly apply on the portal, because it's capital end of the day, and the government entrusts incubators or accelerators like us to deploy that capital to the right people at the right time.
Okay, thanks.
Hi.
Okay.
Hi. So I'm Namrata. I run a venture called Upcycly. We convert fabric waste into products. So is there like a target for like social enterprises to approach them for grants, or in order to, like, we have done about conversion of 1.5 tons of fabric waste into products. So is there like a target, like we have to achieve 5 tons and then we have to approach? Is there something of that sort, or can we just go ask saying this is how we want to scale, and is there like a plan?
There is no such target. So as long as there is as long as the company is generating revenue or it's proved some kind of traction, you can approach investors in terms of funding. Now, what kind of investors you approach, that's kind of up to you, and what research you have done, and what kind of justification of funding you have. So if it's immediately I want large scale transformation, probably funders will have other questions. Okay. But if it's kind of a small step or improvement that you're looking at, probably there will be funders out there to help.
Okay, but will this still fall under the social enterprise sector, or should I, because there are like so many different options, I really don't know which step to take next. I have a POC, I'm generating revenue, I have very good customer base. What next is the question?
What next? You'll have to tell us, right?
Yeah, because okay, I'll take your number maybe.
You can just share your data with us. Sure. Let us tell you.
Super.
So, can I go? Yeah, I have a question for Mr. Sri sir. So when it comes to social impact, a company either profit or non-profit. So when we talked about the numbers, there has to be cash flow when you go for grant or some kind of stuff. So for example, one of my cohort is building a learning platform. She has not have any customers, but she needs some grant as a working capital. So will there be any opportunity for social impact before showing any impact actually or customers working capital access? So is there any possibility to have a working capital access for a social impact venture, either it is a profit or non-profit?
I mean, it's different both ways because non-profits have their way of getting grants. For-profits have different ways of getting grants. So,
Okay.
if you're asking me if these options are open, yes, they are.
Okay.
But reaching out to these specific investors is, or specific grantors is dependent on the person's research.
Okay. So my next question is to Prashant, Mr. Prashant. So I just read in the slide there is an R&D for, it is a purely tech-based company for both of the things, even hardware also involves. So I'm an education-based company running a training for engineering and small micro-scale businesses. So where I felt virtual reality will play a major role. Even to create a 2-week prototype, I need a gaming laptop for 3 lakh, but I cannot afford it. So how can I raise grant, especially for R&D, not to run my company, just to put it over? Where should I look into, and how should I approach? What is the best way possible? And the final question is that everybody asks for a prototype. Even for a prototype, I don't have money. So how should I convince that I will do that if I get the money? So these are the things I want to ask.
See, I think obviously like any kind of capital you're trying to get, whoever is going to give you money needs to know whether you are the right person and whether you have a credible idea. So the simplest way obviously is to see that if you can be part of any sort of incubator or accelerator, because some of them often have grant options as part of them. Also, they get a chance to see you and understand you, and they also know the money is being used well. So obviously that's the simplest and most straightforward way. I mean, NSRCEL itself runs programs, and many of those programs have grants.
Okay.
The other one is obviously you can also apply for government grant programs. Like in Karnataka, you have the Elevate program, right? So the Elevate program has many verticals within it, and then you have grants of varying amounts. And there they will have certain criteria. If you believe that your criteria can fit that, they might be willing to fund even at the concept level. But as in those cases also, they will want to know whether you are going to make the best use of the money. So having some track record as an organization at least is the bare minimum that, you can't be on a paper-based idea with no track record and hope to get it, because they want to know that you are committed and you can make something happen.
Okay, thank you.
Hi, I have a question. I'm Sheetal. I'm sorry I came late, but in case that has been covered, pardon me. We are a Section 8 company, so completely non-profit and looking for grants and all, but that's a later stage. Blockchain for crowdfunding has been utilized by companies outside India. I have noticed that. Has any kind of instance we have seen in India, and is there a possibility of it? Typically considering that you are a non-profit and you want to show transparency, nothing better than blockchain. I would like to know your views on this.
You should take the blockchain question.
No, we haven't seen this yet, I'll be very honest with you. We've also been sort of at Record trying to look at various structures, both underlying instruments as well as certain technological advancements. Haven't seen it up for grabs yet, but I do note a lot of, just some time back, there was another summit that we were attending, which was more on the technology advancement, and a lot of blockchain-based lending was being discussed, just to understand, interpret data, and really try to make sense of unstructured data via the blockchain to eventually lend to certain sectors. So that's where it is, at least on our platform as well right now. We haven't seen anyone actively or any of the lenders actively adopt this technology yet.
We were looking at thinking of using blockchain eventually, and we are just at the POC stage. I'll not even try to say that, but a year down the line, when I really get into crowdfunding kind of a thing, I would utilize, because we plan to finance college education for few students. I think that's where the transparency is really important, and I was contemplating using blockchain.
So there are certain crowdfunding platforms that are there currently, which exist, which are more sort of P2P lending, or for that matter P2P raising, but yeah, they still haven't sort of taken the next technology leap yet, and hence I do believe that this is one aspect that could be looked at.
Hi, I had a question. For the missing middle, right? Like, so all of the alternative financing opportunities you all discussed were for revenue-based companies. And I think a lot of entrepreneurs here are wondering, including myself, like there's this gap between getting to revenue. So are there any, based on what you've seen, any alternative funding opportunities for the missing middle, right? Before getting to revenue, before getting to, even forget revenue, like recurring revenue, right? That takes time. So any alternative funding opportunities that you guys recommend for the missing middle?
What's the revenue stage you're in, if you want to?
That we
just
are
a
in?
range, yeah.
We know pre-revenue to like early revenue, right? Like pilot, like a pilot revenue.
So I think what's really important at this particular stage that you are in is really being able to define your ICP, which is your immediate customer profile. While I understand that your book doesn't currently have revenue, what's the potential? Have you really been have you understood the problem statement of the market? And is your product or the idea that you are working on going to solve for that need? Basis that there are certain programs that I have personally come across, accelerators, incubators, there are cohorts that are being run by various organizations in India today where they are funding companies which are pre-revenue as well. We ourselves have a program which is called Grow, where certain identified companies, depending on what use case are they really solving for in the market and what's the potential to grow, can we get them in touch with maybe HNIs who are in the domain? Because see, the best part of having a platform like ours is that we facilitate transactions. So we map investment thesis on one side. These investment thesis could be of banks, NBFCs, HNIs, and on the same side, we really understand the borrower's use case, and then the matchmaking simply starts. So I would advise that you really take some time and invest in understanding the customer, because post that, there are a lot of opportunities that do exist. There are tons of accelerators and incubators that are on Recur's platform, also helping certain early stage companies as well.
We have time for one or two more questions maximum.
My question is for you or anybody else. See, I have run a successful business for 5 years, which is online and offline classes and training teachers in certain areas of fundamental literacy. And right now, leveraging technology and utilizing the NEP that's coming up, I'm building a digital platform. So right now, I have proved that the problem is existing through classes and taking a different route to address the same problem. So, but it is a heavy tech-based platform and need heavy funding for that. But I don't have that kind of fund to run this whole platform on my own. So right now I'm looking at Elevate as one of my things, and I'm also incubated at NSRCEL, right? So what do you suggest for people like us who have already tested the market in a different way, and now we are looking at solving it in a different route? Like till now it was more offline and online classes. Right now to scale, it is a digital platform, but the problem statement is still the same.
Yeah, that's correct. So see, I think one is that if you already have a track record on your offline or whatever the existing business you've built and does decent revenues and all of that, then you might be able to obviously explore multiple options. It's not necessary that grant would be an obvious option unless you're able to find an alignment of what is a grant scheme and what you are able to build. Because that is basically how grant works. I mean, grant works. One is obviously if you're part of an incubator or a program, then there is a, option of being selected as among the chosen entities and enterprises, which is, I mean, you're part of the NSRCEL cohort, so you know how that works here. Or the Elevate option, which is that you had to have a brilliant idea and you have to pitch it well. But other than that, to be honest, if you see, I mean, in the education business, there are obviously multiple companies, including people like Byju's, who've actually been offline and moved to online, right? I mean, Byju's was offline for 6-7 years before they became online. So it's not like equity guys will not take an interest. It's a question of how you put your proposition. So if you really need capital only to build a solution, fair enough. So what I'm trying to say is if you're just trying to build your prototype and MVP and all that, maybe grant is an option. Or maybe you should just, I mean, it's not probably a bad idea to even look for angel investors, because the amount of dilution you would do is not necessarily
That's
large.
correct.
Like, I mean, the dilution that we did early on is quite small compared to a lot of people that came in, because obviously we found people who sort of knew our track record from before, and so they thought it was worth their while. So we raised capital that allowed us to get rolling with our early MVP and products. We were not raising capital to build some mega business on year one. So that is also an option. So yes, I think we should keep it simple, in my opinion. Obviously, you can do many things, but why complicate life when you can find a simple option?
If I may just add to that, if access to capital is what you're solving for, that is access to VCs, then again there are multiple platforms that provide access to VCs. I mean, they will, strikingly reduce the amount of lean period that you spend in pitching. But my advice here would be that if you have a successful business, then leverage the balance sheet that you've already built. The pivot from offline to online is something which is very attractive because a lot of services business eventually become SaaS businesses. They really eventually want to create a product. So it's a very attractive proposition where you are at, and there would be a lot of instruments that are available for you, especially considering the balance sheet that you have. So play on leverage is what my advice would be. And then access to capital, there are multiple investment banks that can help you in India just to get you the right HNIs, the right form of capital.
How do we know how do we approach them? Because whenever I've knocked on a couple of angel investors, but nothing.
So I think, again, not to blow our trumpet here at all, but this is where, platforms that have the negotiating ball can really help. Considering the volume that is being transacting across the platform, we have that array of investors available. So there are platforms like ours that exist in the ecosystem where syndication of capital is something that we're solving for, access to capital is something that we're solving for. And hence the advice always to entrepreneurs is focus on business. Capital will come. India is progressing and access to capital is far more easier than what it was maybe a decade back. So I will take this offline as well. I'll share my card with you and I'll sort of get you onboarded on our platform and then some similar platforms as well.
I'll tell you about other platforms. Yes. One last question.
आप सभी को नमस्ते। मेरी आवाज़ आ रही है?
जी।
हिंदी में बोलूँगा, चलेगा? तो गांधी जी की ज़रूरत समय समय पे सबको पड़ती है, सत्य, प्रेम, सेवा, और इसी के लिए ये अल्टरनेट फाइनेंसिंग का ऑप्शन है। बगैर गांधी जी का इंडिया में सक्सेस नहीं है। और जैसे हर जगह पे एमजी रोड है, वैसे ही हर सिटी में वेंचर, एंजल, बैंक हर जगह है। तो मेरा सवाल ये है कि दो चीज़ें होती है, एक टैंजिबल चीज़ें होती है, एक इंटैंजिबल चीज़ें होती है। अपन बैंक में जाते हैं, 50 पेज के डॉक्यूमेंट में साइन करके सील लगा के करते, पूरा ठप्पा फाइल लगा के, वो टैंजिबल है। तो मेरा सवाल ये है आप लोगों से कि क्या ऐसी 4 चीज़ इंटैंजिबल जो नहीं दिखती है वो आप लोग देखना चाहते हैं, चाहे वो कंपनी में हो, चाहे वो एंटरप्रेनर में हो, ये अल्टरनेटिंग फाइनेंसिंग के अलावा जो है, तो बिजनेस को, कंपनी को, पर्सन्स, मतलब बहुत बार होता है ना इवैल्यूएशन के मैट्रिक्स में चीज़ें देखी जाती है, बट आप लोग क्या हट के देखना चाहते हैं जो अदृश्य होती है?
देखिए, मैं आपको अपने साइड से बता देता हूँ, बिकॉज सिंस हम लोग जब से एग्जिस्टेंस में रहे हैं, वी हैव बिन वेरी फोकस्ड ऑन वन पर्टिकुलर एस्पेक्ट, विच इज़ कि रेवेन्यू जो कंपनी का है उसका बिहेवियर कैसा है। वो रेवेन्यू एज एन एसेट क्लास फाउंडर्स यूज़ कर सकते हैं या नहीं टू गेन लेवरेज इन द मार्केट। जो हम एक चीज़ देखते हैं रेवेन्यू का बिहेवियर में इज़ की साइक्लिसिटी कितनी है रेवेन्यू की। ये साइक्लिसिटी की ओरिजिनेशन कहाँ से हो रही है, एक कस्टमर से हो रही है या मल्टीपल कस्टमर से हो रही है। दूसरा दिन हम देखते हैं कि इसी रेवेन्यू का जो बिहेवियर है वो कितना रिकरिंग बिहेवियर है, कि ये आपकी जो कैश फ्लो रियलाइज़ होती है या कैसे रियलाइज़ होती है। एंड द थर्ड एस्पेक्ट जो मैंने अपने डिस्कशन में भी किया, प्रिडिक्टेबिलिटी ऑफ रेवेन्यू आपकी कैसी है, टू अंडरस्टैंड आपका बिजनेस मॉडल, कि आपका जो कस्टमर है, हम लोग इक्विटी इन्वेस्टमेंट की तरह नहीं सोचते हैं कि हमें आपका टैम देखना है, या हम आपकी पहली पिच या पहले पिच डेक पे आपसे पूछेंगे कि आप हमें बताइए कि आपकी गो टू मार्केट स्ट्रैटेजी क्या है। हमारा बेसिस पूरा फंडा इज़ आपने हिस्टोरिकल क्या करा हुआ है, एंड हिस्टोरिकल लेवरेज के साथ मैं आगे आपके लिए क्या स्ट्रक्चर बना सकता हूँ। सो हम लोग रेवेन्यू देखते हैं कंपनीज का, विच इज समथिंग जो विजिबल नहीं है, जो नेकेड आई को नहीं दिखता है। बैलेंस शीट में आप सिंपली पर्टिकुलर्स डाल देते हैं, बट उन पर्टिकुलर्स को आप एक्चुअली लेवरेज कर सकते हैं। दैट इज समथिंग दैट वी आर ऑन, एटलीस्ट एट रेकर क्लब, ऑन ऑलमोस्ट ऑल सेक्टर एग्नोस्टिक कंपनीज दैट वी वर्क विद, वी लुक फॉर।
You want to add on anything?
Yeah, I think being in the impact sector itself is a lot of things that normally commercial guys do not see. So the kind of impact you're creating, the reach that you have, all of that typically doesn't get measured. So impact investors, of course, wear that lens when they are looking for investing. So other than just the financials, or doing a diligence on that. They actually get onto the field, see all of this, talk to the people you're kind of benefiting, and then try and understand if real impact is created. Only then maybe kind of fund.
Great. Great. So I'm just going to close. I've noticed one or two trends here. One is a lot of questions on early stage pre-revenue sources of capital. I think probably NSRCEL should take the responsibility of sort of creating an FAQ or some sort of a Wikipedia for this. We'll take it back. The other thing I've noticed as a trend is a lot of questions on, I've been having an offline business. Now I want to do online. Now can I do, can I approach a Recur, a club, a Let's Venture, whatever. And I'm sure you guys had a lot of such transitions that you have seen. So that is a trend that obviously a lot of entrepreneurs, a lot of enterprises have thought about post-COVID, and it has worked in good favor of a lot of ventures because you've sort of opened out the target audience that you probably did not have. But I think I would close it with one learning for all is, and especially for growing entrepreneurs like you, is keep your eyes open. There is nothing wrong with equity. There is nothing wrong with debt. There is nothing right or wrong with any form of financial instrument. Keep your eyes open because there are a lot of different financial instruments coming in, a lot of financial platforms coming in. Do talk to people in the sector before you decide what you want to do. Because again, any innovative platforms that come in will, an entity like an RBI or a SEBI catches up much later. So keep your eyes open on whether that part of it is also being validated. There have been issues, but as I said, I think nobody covered this concept of equity crowdfunding, which has been established in the US from 2015, but then the laws came in 2019. Similar things are happening in India as well. And this will happen with any new technology or any new innovation that's going to come in. So yeah, keep your eyes open, and that with your personal and professional goal, you guys know where you want to be. Some entrepreneurs come to us and say, hey, I just want to blitzkrieg scale, and I want to exit this venture in 3 years, and I want to move on to the next one, right? Then your whole journey is completely different. And then we have committed entrepreneurs who come and say in a different way that, hey, this is what I want to do for probably the rest of my life, or at least for the next 10 or 15 years. Or I'm actually taking over a family business, but I want to do it in a different way. Your fundraising journey is completely dependent on these two factors, where your personal financial goals and your venture's financial goals. So I think, with that we can close. Thank you, thank the panel for taking their time and giving us the wisdom, and thank you all. Wouldn't delay your lunch further than this. Thank you.
Thank you.
Thank you.